second, data, which is number 7. I have some other stuff in the calculator from before. I'll just go second clear. So now everything's cleared out. So I showed you last week that the financial calculator allows you to insert the X and the Y, or 2. But we can also use it just for 1. How we do that is let's just put everything into X. So in this question, I have 54.07, 10.54%. I like to convert everything into decimal points just because when you're calculating variance and standard deviation, it's just a little bit more accurate with the decimal points. So I go 0.5407, enter, down, asking for Y. I don't have a Y, so we can just ignore it. X2, 0.10. Oh no, I did something wrong. Okay, X, no, I didn't. Okay, my bad. No. 0.1054, X3, X9, then 29. Last one here is 0.3. Okay, after I entered all 5 numbers, I like to scroll through it to make sure everything is correct. So going from X1 again, so it's making sure that everything is correct. X2, X3, X4, and X5. Okay, everything looks good. So I go second stat, all right, which is number 8, second stat. It shows linear regression. This is what we want. So good. N equals 5. There are 5 observations. So the arithmetic average for X is 24.94%. All right. Again, you don't have to manually calculate this. It will show you that's the arithmetic average. Geometric average will be calculated differently because it's not available in the calculator. So you will have to do this by hand. All right. How would you do that? Let's go back to the question, geometric average. So 1 plus the percentage was 1 plus 5407 times 1.1054 times 1.0. I'm just gonna write the second line. Times 1.2. All right, so everything plus 1, multiply them all together. Root to the power of number of observations, so which is 5 minus 1. So that will be your geometric average, okay? I'm not gonna do the math here, but you guys can figure that out. The other question here is what is the standard deviation? However, there is 2 types of standard deviation, right? Sample standard deviation and population standard deviation. If you scroll down, the first one here, sample standard deviation. So divided by n minus 1. That's statistics 101. I'm not going to cover it in this course, but you guys understand the difference between the 2, right? The difference between population standard deviation and sample standard deviation. The question here asks for sample, so that's it. That's what it is. If you are calculating the population standard deviation, which is the next one here. Okay? That's it. So for this question, it's pretty simple. You can use a financial calculator or you can do it with any scientific calculator. Questions? No? All right. Yeah.
I have a question. So
Yeah.
When we do the data in the
Yeah.
financial calculator,
Sure.
we enter X, and then you said we don't need to set up anything for Y, so Y will be automatically at 1. Is it correct? It's 1, not 0?
No. So what that does, right? The calculator basically gives you a function of a regression. So it takes in a Y and an X. So if you go like this, Y, X, okay? So it allows you to enter 2 series of numbers. But if you only have 1, that's fine. Then Y is always going to be 1, but X is going to be different, right? Doesn't matter. But all you care is X. Y is always going to be 1. Did that answer your question?
Yeah.
Okay, good. Anyone else? Okay, good. All right, as I've mentioned, today's the last class, so no class next Tuesday. Now, you should spend all the time preparing for your final exam. Final exam is going to be very similar to the mock exam which I just published, okay? Expect 20, 25 multiple choice. In fact, I'll tell you, 25 multiple choice questions, 3 to 4 calculated questions. So the calculations are the categories I mentioned in the previous class. Those were definitely is going to be an exam similar to the mock exam. But what I did something different this time, all right, as I mentioned, I don't curve. So it's all going to be on you. Not going to curve up, definitely not going to curve down. I try something different this time. I throw in a bonus question. That's 10%. That's worth 10%. So instead of, all right, well, I'll let you figure it out. But anyway, there's a bonus calculated question, so you can earn up to 110% in the final exam. But then that's it. I'm not curving it. I hope I'm doing a good job, so it will really assess your knowledge, and we'll leave it at the grade untouched. Okay, and I don't. That's FYI, right? I will ignore all the emails after the final and say, oh, I need 0.7% to get to the next grade. I don't do that. I don't. I just ignore it out of respect. Okay, I don't. So.
Do you get partial credit for the bonus, or is it better?
Oh yeah, partial. Sure, why not? That's a great question. I didn't think about that, but sure, I'll give it to you guys. Yeah. Okay. The mock exam is there. Please do it. That's really the only way to do well in the final. Do all the end of chapter questions. Do the mock exam. Ask lots of questions. Office hours still going to be available to you next week, both the TA and myself, all the way to the final exam. Okay. Today's class is also covered in the exam. Outline, chapter 11, risk and return. So we started talking about risk and return last class. Why do we care? Why do we care about risk and return, right? Last class we learned how to calculate risk and return from historical prices. This is how we describe how well we've done in the past, right? So risk and return, risk and return, risk and return. I'm going to repeat that multiple times because that's the big picture, is that we try to get what is the risk of this thing and what's the historical return, and hence, more importantly, can we use that information to project what is the future risk and return? And really, that's the goal. Of all the investment, we want to have a good guess of what will be the risk and return for any of these investments. But today, we're going to put this into a portfolio context. So meaning that instead of looking at individual security, we're looking at a basket of security. How are we going to manage a collection of these securities? We also introduced you to one of the most important concepts in finance called the CAPM, not the CAPM. We call this the CAPM. The CAPM, capital asset pricing model, is probably one of the most important fundamental formula or theory that you will learn in any finance course. However, although this is a long list of things that we're going to learn today, most of the things here I'm going to keep it at an introductory level. Okay? When you actually take your MGFC 35 or 45 or any higher level finance, they would actually dive a little bit deeper into these concepts. But what I learned from the 9 o'clock class this morning is that you guys seem to be surprised because when I go through these topics, much of it actually ties back to statistics. That's why we're doing this. Remember I told you finance actually has a lot of cross discipline, right? Accounting, statistics, economics. Today, it's all statistics. All right, some of them but near the end of the class. And I'll warn you, okay, once we get to the more intense stuff, I'll take breaks, I'll make sure you guys get refreshed, because that's when the morning class kind of struggled. We're like, oh, right, what's this? It's all statistics. Anyhow, to me, this is fun stuff. You'll read all these chapters, they are all covered in the final exam. So let's start with the important concept, the characteristics for any individual security. So securities include what? Stock, bonds, any investable stuff like real estate or whatsoever. They can be measured in terms of risk and return, all right? Return, expected return. So this is expected, meaning it's a guess, okay? We are trying to guess what would it be over usually a year's time on what the return would be. And we also talk about risk. What is risk? Risk is measured in two ways, either variance or standard deviation. All right, this is the volatility of the security's return. Now, we're gonna add a new concept Because we're building a portfolio have multiple securities. So we have to actually study the relationships between these individual investments. We call this covariance or correlation. Covariance or correlation. Again, this is statistics, how they interact with one another, okay? All right, let's get started. I'm going to show you, this is the science part of finance, where we're trying to come up with a framework, all right? Again, no one knows the future, right? As the movie says, you know, Warren Buffett, Jimmy Buffett, whoever. Nobody can predict the future. But we still need to do it. Someone has to predict how this is going to play out. And we need some kind of framework. We need some kind of model that can actually show, you know what, we've done this work, and based on our model, this is what the future says. Sure, I could be wrong, but this is the best I can do. So this is one of the most simple predictions that you can make. Now, there are 4 scenarios, possible scenarios for future economy. What do you think? Either it's going to be depression, recession, normal, or boom. All right. What about the Canadian economy? What's your thought? Do you think it's going to be in a depression? Anyone? Next 12 months? No? Okay. How about recession? 1, just 1, 2, 3, 4, recession, okay. Normal. Not good, not bad, right? 1. Normal. 2, okay. Boom. No? Okay, so what about the rest of the class? No idea. All right, so here's the thing. You have to have some kind of expectation. And that's the thing. Outside of the class, I'll tell you, in finance, it's more important that you always have your own independent thought. All right? You cannot have no idea. Like, you have to have some idea. You could be wrong, but you have to have some idea. Well, what's your guess? People ask you, what's your guess? What's the economy going to be like? You have to have some ideas. But anyhow, this is how the model works. Analysts would create 4 scenarios, all right? And under the 4 scenarios, I have 2 stocks. And this tells you, under each scenario, what is the expected return. It's a pure guessing game, all right? But at least it gives us some framework on how to predict how this is going to play out. We have 2 stocks. We have Supertech, which is one company, and the return will be -20 when it's a depression, 10% when it's a recession, 30% normal, and 50% boom. So this looks like a pretty typical company, like a growth company or a tech company, right? The other one here is called Slowpoke. It's quite interesting. It behaves quite differently. Under the normal scenario, it would actually drop 12%, but it outperforms when there's a recession. Quite interesting. I don't know, just out of curiosity, what would you guess? What kind of company behaves like that? What do you think? So based on these scenarios, this one's not hard to guess. Most of the typical company will follow this pattern, right? But what about this pattern? What kind of industry or company will outperform during recession? Yeah.
A company like gold.
Like what?
Gold.
Gold. Sure. I don't see why not. Yeah, recession. People will, instead of investing in growth company, maybe in. But then gold. These are miners, right? Sure. Why not? I can't say that's wrong. Yeah.
Maybe like stuff like pawn shops.
Pawn shops. Yeah. Some people were saying like maybe something would do well during recession. Like what do people do when there's recession? They spend less, or they spend more on the inferior goods, right? So in the morning session, people were suggesting maybe Dollarama, something like that. So instead of buying more expensive stuff, people buy the cheaper stuff, and they would outperform. So anyhow, that's just for fun. Now we have 2 companies out of these different scenarios. The question here is, if I have to calculate what is the expected return and the risk, which is variance and standard deviation, how would I calculate this? Okay, this is calculated by the weighted average, okay, weighted average. So in this case, we have 4 scenarios, and the 4 scenarios are equally probable. So 25% chance of each of these things that are going to happen. So the analyst would actually weight in on the weight or the probability of this happening and calculate the weighted average of the expected return. So for each of the stock, because of equal probability, we're just doing an average here. This is the most simple case. In the final exam, previous final exam, I've seen a similar question. But instead of asking for equal weight, they will be assigned probability for each of the scenario. Then you would have to calculate the weighted average. Okay? So you can see that the two stocks, the expected return, given the probability, equal probability of each of the scenario, the expected return for Supertech is 17.5%. The expected return for Slowpoke is 5.55%. Now, the other way to do this, we can actually put it all in the calculator because we're going to calculate the rest of the stuff, so I want to show you how to do this again on the calculator. Now we've got two stocks. So we have an X and a Y. We can go second data, second clear work, and start new. Again, I like to put everything in decimal place. So 0.2 for X, 1, that's under depression, and the other Slowpoke is 0.05, which I'll put it in Y. So I'll continue to do that to enter everything. X3 is 0.3, Y is negative. Yeah, this is really helpful if you're able to do this together. Again, you learn a little bit faster and you get some experience in putting this in. So I've put in both two stocks, 4 different scenarios. Let's scroll through them again. So I got 0.2, negative 0.2, 0.05, 0.1, 0.2, 0.3, negative 0.12, 0.5, and 0.09. Okay, so both of these are entered. I can go second, stat. So this is a linear regression. 4 observations because there are 4 different scenarios. Now, the first question is, what is the expected return, right? So meaning just the average. The average of it, the first one, 17.5, which matches the air. The second one is the average of Y, 0.55. I'm not sure why I have 0.555. I think probably that's a typo. I trust my calculator. 5.5%. And the next question here is, what is the variance? All right, what is the variance? So you should also learn how to do this by hand. All right, 4 different scenarios. What would be the risk for each of these stocks? Again, this is Stats 101. I'm not going to cover the formulas here, but in short, right, you're going to find the deviation from expected return. So the expected return, consider it as mean. So each of the observation minus your expected return, square them. The sum of it divided by 4, that is your variance. This should be taught in statistics class. Now, that's how you would do it by hand. If you don't want to do it by hand, you want to do it through a financial calculation, sure, you can do that. So what we're trying to calculate here is either the standard deviation or the variance, right? So you can see on my screen, it shows the population standard deviation. So population standard deviation, 25.86%, 25.86%. Why population? Because there are only 4 scenarios here, and we needed to account for all 4 scenarios. So we're using the standard deviation of the population. Okay? The standard deviation of the population of Y, 11.5% on the calculator. 11.5 matches the one that you would calculate by hand. So here's the thing, depending on what you're using the calculator or if you were doing this by hand, you know how to convert between variance and standard deviation, right? It's just a square root. So standard deviation is just the square root of variance. Depending which way you're gonna do it, sometimes a question gives you variance, sometimes a question gives you standard deviation. Just make sure you know how to convert the two. Okay? Question? Now we covered return, risk. Now here's the fun part. This is the covariance and correlation. This is where we actually try to figure out if these two things have some sort of static static relationship. Is it positive? Is it negative? Do they move together, right? So I have two stocks that behave quite differently, and how do I calculate the covariance? I have the return of Supertech. I have the return of Slowpoke. So this column is the deviation from the average. So observation minus expected return, observation minus expected return. The product of these two is called the product of deviation. Divide that by 4, that is your covariance. Again, these are statistical equations, not even finance. Make sure you review them in your stat course. You'll be able to calculate covariance. Now, with covariance, how do I convert that into correlation? How do I convert it to correlation? So you just take covariance divided by the standard deviation of one of the stock and the deviation of the other stock. So that equation will allow you to convert between covariance and correlation. What if I don't want to do this by hand? Sure. Remember the calculator. If you continue to go down, that R in the calculator, that is correlation. That R is correlation. So you can see in the calculator is 0.1639, negative 0.1639, negative 0.1639. So you do it by hand, do it by the calculator, it would be the same thing. Okay? Questions? Yeah.
Can you one more time tell what does correlation represent?
Yeah, it's going to be on the next slide.
Ah.
Okay, let's get to the next slide. What is covariance and what is correlation? They both measure the same thing. They both measure how two things are related to one another. Okay? However, these two measurements are different in a way that covariance measures whether the two variables move together and which direction. That's it. Just which direction. All right? Covariance is scale dependent, so that covariance across different variable pairs are not comparable. I'll give you an example. If I want to measure the two stocks and see how they move together, let's pick Apple and Microsoft. That's one pair. I want to pick another pair. That is maybe Apple and JP Morgan, which is a financial. Can I compare the two covariance? No, because they're not comparable, right? Using covariance, no. Covariance is not according to scale. It only tells you the direction of it, whether they have a positive or negative correlation. So using that example, Apple stock and Microsoft stock are mostly considered correlated, like any of the Magnificent Seven. Netflix, Tesla, what else is there? Apple,
Google.
Amazon, Google, right? They're all correlated. Why are they correlated? Let's talk about that a little bit. Correlation. Why do you think these stocks are correlated? Why? Well, first of all, do we agree that they have some sort of correlation, positive correlation? Yeah? Usually one goes up, the other one will also go up. Why is that the case? Anyone? No? Well, let's think about this, right? They correlated because these stocks have the similar exposure to similar macroeconomic factors. Would you say that? Right? Or similar factors. What would be these factors? I don't know, demand for technology, right? Demand for investment into technology, demand for AI infrastructure, something like that. So these are all common denominators for these stocks. So if those factor increases, stock will increase. And because they all quite similar, they will both benefit from it. So there's some correlation there. What about negative correlation? For example, maybe a banking stock versus a technology stock. I'm just guessing. Maybe positive, maybe neutral, maybe negative, depending on the situation. You actually have to calculate that. but that is covariance, all right? Now, let's finish correlation. Covariance. Covariance, if you have a positive covariance, both variables tend to increase or decrease together, similar to the example that I just mentioned, the Magnificent Seven. What about negative covariance? Negative covariance would be one goes up, the other goes down, or one goes down, the other goes up. They kind of go in the opposite direction. If you have zero covariance or very little, very small covariance, they probably don't have a linear relationship. Okay? Which happens. So it would either be these three situations. Now, what is correlation then? Correlation standardizes covariance onto a fixed scale. So now there's a scale from -1 to 1. So now we can compare how strong that correlation is. Okay? So this is very useful when you're comparing the pairs. -1 to 1. That's correlation. So if in the question, or depending how you're approaching this, I hate to think about this using the exam approach, but in real life, when we are actually measuring things and seeing what is the relationship between these two things, depending how you calculate it, if you are using the table, you got to get through covariance, and then you can always convert it into correlation using that formula. Then you can compare the different pairs. If using a calculator or using some kind of software, you may be able to get to correlation immediately using these. Okay? How are we doing so far? Good? I know it's a lot of statistics. And I was joking this morning that if you think this is not something you can handle and you might want to quit finance, well, good luck, because anywhere you go, even just science or any biological science, you need to do this. It's just same statistical concept, right? Calculating mean, standard deviation, and then doing t-tests and all that kind of stuff, z-test, t-test. So it's just being applied to finance here. Okay? All right, so let me cover a little bit more, and then we're going to take a short break, and then we can come back to it. Now, we learn how to calculate risk and return. But what about in a portfolio context? Okay, we learn how to do it for individual stocks, but now we're putting things together in a portfolio. What is a portfolio again? We're combining more, or one or more, of these assets, either stock, bond, real estate, even cryptocurrency, whatever you like, into a basket, and we would like to measure the risk and return of this basket or this portfolio. Again, it's about risk and return, but in a portfolio context. So some factors to consider when we're putting things together. It is the relationship between the expected return on the individual securities and the expected return on the portfolio that make up all these. So three things that we need to know. Besides the individual risk and return, it is the risk of the individual return, and more so we need to care about the correlation between these securities. Okay, because the standard deviation of the portfolio is made up of these securities. So I will show you how to calculate in a portfolio, how to calculate expected return and risk. Everything is about risk and return. Let's start with the return. The expected return on the portfolio is a weighted average of the expected return of the individual securities. That's a generic formula. So again, remember expected return, so E, expected, meaning we're guessing. This is something we're trying to guess in the future. What is the return of the portfolio going to be in the future? Based on what we're guessing what the return of the individual security that's going to be in the portfolio plus times their weight, and we add them all together, okay? So the portfolio weight of a particular security is a percentage of the portfolio total value that is invested in the security. When adding everything together, the portfolio must equal to 1. The weight must equal to 1, right, 100%. So let's take a look at some of the examples and how this is being calculated. So far, this is easy stuff, okay? This is a very, very easy stuff. If you struggle, if you have a question, please ask. Consider a portfolio consists of the two stocks that we just mentioned. Super Tech and Slowpoke. If the investor invested $60 in Super Tech, $40 in Slowpoke, expected return for Super Tech is 17.5%. Expected return for Slowpoke is 5.5%. What is the expected return of the portfolio? So this portfolio, what do we expect with this kind of breakdown of the investment? So let's write this down. I am pretty sure this question is on the exam. I'm pretty sure, if I recall correctly. Simple stuff. Probably multiple choice, if I recall correctly. Okay. Sorry, I'm not teasing you. I'm teaching too many courses. I try to remember. I'll tell you if I remember. I'm pretty sure there's something like this. All right. So the expected return of the portfolio. This is guessing. All right. Equals. In this case, there's only 2 stocks. So the weight of the first stock times the expected return of the first stock plus the weight of the second stock B times the expected return of the second stock. There you go. That's it. If you have more than 2, you just keep going. All right, you just keep going if you have more than 2. But at least in this class, in this course, we're gonna give you something very simple. In real life, nobody does that. No, who has 2 stocks in the portfolio? You gotta have more than that. You gotta have at least like what, 40, 50 stocks. But because this is Finance 101, we're gonna give you the most basic ones. So this is, make sure you understand this is not realistic. No one has 2 stocks, but we're gonna start here. If you wanted to add more, you just keep adding it, right? So first of all, what we need to know, right? The weight of A plus the weight of B must equal to 1. 100%, it has to be. Or if you have more, then all of them add up together must equal to 100% of the portfolio. But let's go back to this question. Okay, weight of A. What was it? 60 bucks. So 60% goes to Super Tech. So Super Tech is 17.5% plus 40% that goes to Slowpoke, 5.5%. So what's that? Anyone, please?
12.7.
Yeah, I don't have the answer. Was it 12.7?
7.
Okay, thank you. Can we agree? Agree? Okay. So this. That's the return. That's how we calculate portfolio return. Just the weighted average of the expected return. That's the easy part. All right, ready? That's risk. All right. Jeez, what am I looking at here? All right, that's the equation. All right, that's the generic equation for the risk. That's a variance of a portfolio. It's the sum of 2 parts. The first part is the square of the weight times variance plus weight 1, weight 2, and the covariance. That's the generic formula. Okay? However, it looks scary, don't worry. Alright? That's a simplified version of it when there are only 2 securities. Again, in this course, I'm only asked you 2 securities. But in real life, you're gonna have more than 2. This equation is gonna be gigantic. Right? Imagine, because it measures the covariance. If you have 2 securities, you have 1 covariance. You have 3 securities, you have 2 covariance. 4 securities, right? You keep adding these covariance. So if you have 20, 30, even 100 securities in a portfolio, this thing is going to be massive. No one's going to do this by hand. We're only doing this by hand because we want to show you this is the original equation and how it is being calculated. Okay? In real life, people would use a software or Excel to do this for involving multiple securities. But for 2 securities, you guys need to know how to do this. At least the good news is, if you don't want to memorize this, just write this on your crib sheet. I'll give you everything. I'll give you the weights, I'll give you the variance, I'll give you the covariance. The only tricky part is if I don't give you the variance, I'll give you the correlation, so you gotta convert it, or I'll give you the standard deviation instead of variance, and you gotta convert it. That's the hardest you can get. And honestly, like this, at least in my personal opinion, if you see questions coming out of the last two classes, you should be laughing, because those are the easier ones. All right, you just plug it in. So this last one here is the standard deviation of a 2-asset portfolio. Again, not realistic, but that's what what you need to do. So here's the case. Consider the previous example. Instead of individual securities, we got two, $60 in SuperTech, $40 in Slowpoke. All right, let's write out the equation. Okay, so now we're looking at risk. What is the generic equation again? So standard deviation of the portfolio equal, okay, the first part, I'm trying to remember it. WA, variance, oh my God, getting old. Plus B square plus 2WA WB covariance. Okay. Alright, that's what I told you to write on your cheat sheet. So now you just have to plug those numbers in there. What are the numbers again? WA 0.6 squared times variance. Variance is given to you 0.0668. Okay, plus 0.4 squared times the variance of Slowpoke, 0.013225 plus 2 times 0.6 times 0.4 times covariance. Again, covariance given to you, so it is negative 0.004875. Done. Square root. All right, that's it. All right, I don't want to calculate this, but I got the answer, so I'm just gonna give it here, 15.44%. You guys can verify that when you have time. Okay? Questions? So now what we have covered in the first half of the class, risk and return. Again, simple model, we have different scenarios. Economic scenario, whether it's a depression, recession, normal versus boom, how do we calculate the return is that we give these expectations, have a weighted probability, a weighted average to figure out what's the situation, what's the expected return. Again, we're trying to predict the big picture. I want you guys to focus on the big picture. All we're trying to do here is to predict what is the expected return for a stock, what is the expected risk for the stock. All right, we can do it in the past based on historical data, but today we're changing it a little bit. Instead of using historical data, we can actually, based on scenarios, how are we gonna predict that? Moving on, we're doing it through a portfolio setting. So instead of individual security, assuming that we have expected risk in return for all the individual, when we put them together in a portfolio, how do we actually calculate them? So we have return, which is up top, weighted average, risk, which follows this equation for the portfolio. Okay, so here, what I'll do is, I'll take a short break, all right? Let's do a 10-minute break. And meanwhile, if I can ask you guys for a favor, for those who have yet to fill in the course evaluation, please do so. I'll give you guys some privacy. I'll be back in 10 minutes. Other than that, let me know if you have any questions, okay? And we'll resume in 10 minutes. Second half, I'll need your full attention, so. All right. We good? Any questions from the previous part? No? Okay, let's talk about diversification. All right, any reasonable people here would understand the benefit of diversification. Instead of putting all your eggs in one basket, there's a certain benefit for investing your money in a little bit of everything. So how do we quantify that? Let's understand the concept of diversification. So the first idea is that any single security, when we look at the risk can be divided into two parts. The first part is called systematic risk. The other part is called unsystematic risk. Let's start by systematic risk. Can I have a stock? Anyone? Any idea? Give me a stock. Any stock? NVIDIA. Okay. NVIDIA. So when we are looking at NVIDIA, for the risk of NVIDIA, there are two parts: systematic risk and unsystematic risk. Systematic risk is also called market risk. So here's an example. Let's say news came out that, let's assume, okay, I know it's not a good example, but let's say war continues and expanded. The US actually started to firing missile in Iran firing missile back to everyone else around the region. What do you think the performance of NVIDIA is going to be because of that result? Up, down, or neutral? Down. Why? Missiles have nothing to do with NVIDIA.
QQQ down.
Why is QQQ down?
All these stock.
Why is all the stock in the QQQ will go down? No, this is a reasonable question, right? Yeah.
Because investor confidence will go down. It's a macroeconomic.
Very good.
situation.
Macroeconomic condition. All the investor confidence will go down. Shooting missiles have nothing to do with NVIDIA, but NVIDIA will most likely go down. This is called market risk. That is because, in generally, the market have one big common economic factor, is that if the market in the general is impacted, the individual stock will be impacted. Doesn't matter NVIDIA, TD Bank, Royal Bank. If something that happens to macroeconomic factor, you will be impacted somehow. Yes?
Using that example you just used,
Yeah.
certain stocks also rise, like Lockheed Martin or other
Sure.
wartime stocks?
Sure. So hold your thought on that. Well, we're talking about generally market risk. That's a very specific issue about war. What about it was another macroeconomic news? Again, I can only think about bad things. Oh my God, that's not good. But let's say there's a natural disaster somewhere. Do you think Lockheed Martin's gonna have a good day? No. Do you think the market's gonna have a good day? No. Right? So again, those are the macro factors that we're looking at. The general market. That you cannot do anything about, right? Nothing is spared, given that the market have a general movement. However, when we're looking at unsystematic risk, meaning that these are random events that affect single security or a small group of securities, meaning that very specific to NVIDIA. See, I would hate to use the hit by a bus theory again. I don't know, but then I can also use a positive, like if Jensen Huang won the lottery, he already won the lottery, so that doesn't apply. So let him hit by a bus. Let's say if Jensen Huang was hit by a bus, do you think the stock will go up, down, or neutral? NVIDIA. down because he's such a key person in this company, right? What about TD Bank? If Jensen Huang got hit by a bus, is TD Bank going to be impacted? No, because this is very company specific or industry specific news. These are called unsystematic, diversifiable risk. So the idea here is that if we add multiple securities in our portfolio, we are able to avoid some of these unsystematic risks. Meaning that instead of having 100% in NVIDIA, Jensen Huang, something happened to him, God bless him, but if something happened to him, my stock is gonna tank. But if I have a little bit of everything, fine, Jensen Huang, again, something happened, but I still got other things, so my loss is not gonna be as much. It may even be counterbalanced by the other things. So that's the benefit of diversification, but can we measure that? That's the key. The overarching goal, what are we trying to do here? The big picture. We're trying to create a portfolio of stocks that would maximize return, minimize risk. That's the big goal here. And can we do it scientifically? Yes, we can. And I'm going to show you how to do that. Okay. So at the end of the day, the effect of diversification, unsystematic risk will be significantly diminished as you continue to add securities in your portfolio. However, the systematic risk cannot be affected by diversification. Yes?
If you over-diversify your stocks, so don't you risk lowering your returns?
Yes, you do. But hold your thought. You're a little bit ahead of everybody else. Let me talk about this and I'll address your question. So let's take a look at this graph here. On the y-axis, this is risk. This is variance. On the x-axis, this is the number of security that you would include into your portfolio. If you only have one stock, very risky, because your portfolio, much of it will be systematic risk and unsystematic risk. Okay. If you continue to add security, you start to decrease, you kind of diminish that unsystematic risk because it's diversifiable. However, what you notice here in the bottom, this is the systematic risk that you cannot reduce. So the best you can do is to keep adding it until that blue line is as low as possible, until it almost no longer go further down. That's the idea. But how many stock does it take to get to that point? 2 stock, 5 stock, what do you think? How many securities do I have in this portfolio until I'm happy? Is there a problem with having too much? So that was the question. Is there a problem if I have too many? All right, so to address the first question, what's the optimal number? There's no optimal, all right? However, researchers tried to answer that question, and based on the recent publication, they say 25 to 30 stocks would be the optimal point. Yeah?
Single stocks or?
Single, yeah. 22, 30. 25 to 30. That would be the optimal number of securities to hold in a portfolio to be that happy medium. But can you continue to add? Sure, you can add it to like 500 stocks, 600 stocks. That's fine. But then what creeps up here is that diversification is not going to get any better, but it would also not harm return. But what harms return is that once you have 600 stocks, it's the administrative cost, it's the trading cost that's going to start to eat up the return. But for theoretically, it's not going to do anything. Theoretically, it's going to be just continue to extend that blue line and continue to add that beneficial diversification effect into it. Okay? Questions? Not convinced? Convinced? Good? Okay, so again, I will take you down to the most simplistic case. Not realistic, but simple. We only have 2 stocks to consider. In this portfolio, we have Slowpoke and Supertech. Here's the situation. Return, risk. If we have in this portfolio 100% of Slowpoke, what would happen? The risk and return will be 5.5 return, 11.5 risk. Because we have 100% Slowpoke, right? That's literally the risk and return for Slowpoke. On the other hand, or the other extreme, we have 100% super tech. We're gonna have 17.5% return, 25.86 risk. That's 100% super tech. So the idea is, if we're gonna have a portfolio of these two stocks, how do we weight them? Should it be just a natural 50-50? Not necessarily, right? We wanna find the best combination between these two stocks. So if we draw a straight line between these two, that should be the expected risk and return of the combination between the two stocks, correct? No, that's not the case. What's interesting is, when we combine two stocks, instead of a straight line, it actually curves. I'll show you what it would look like. If I combine these two stocks into a portfolio, instead of a straight line, it actually creates a curve. It's like a little belly that bulges on this side. Why? And it's good to be on this side. Remember I told you on Tuesday? Out of the quadrant, which side is the most beneficial? Top left. Top left. Why? The top left has less risk, high return. Again, what is the big picture? We're trying to create a portfolio with the highest return with the lowest risk. So in this case, if I have a combination of slowpoke and super tech, the combination will be on that curve line. And again, why is it not straight? Because there is diversification benefit that would pushes it to the left into a curve, meaning that there's additional benefit for combining these two is more than 1 plus 1. And hence, you have that little curve. Okay, so first, I know this is quite a bit to digest. I would give you guys a moment to ask question, and then I will show you how this is done in practice. So hopefully that will relate a little bit more. Questions? Okay. Please don't hesitate to stop me at any chance. Now, I'll show you how this is being done in real life. Okay, let's say I have two stocks. The first one here is called DSG. This is Descartes System. It's Toronto stock. It's a software development company. Descartes System. The other one is CNR, Canadian National Railway, right? Transportation stock. I have two stocks. I got a few years of performance data on a daily performance. All right, two series of data. Now, remember, if I have two stocks, I want to put it into a portfolio. These are the formula. If I want to find the expected return, I would use that. If I want to find the expected risk for the portfolio, I'll use this. What do I need in order to find risk of the portfolio? I need variance and covariance, correct? So I have two series here, two stocks. What I can do with Excel is to do a covariance matrix. Anyone have learned or have done covariance matrix? Is not statistics. You heard of it, right? Covariance. Okay, I get the same reaction from 9 a.m., so I'm kind of surprised. Okay, so don't worry. If you don't learn this, I'll tell you. This matrix is a product, okay? It's done by Excel. It's done by Excel. You don't have to calculate this. You take two series, okay? And what it does is simply calculate the variance, so you can see this box here. DSG and DSG, that's called the variance. Which is this guy, variance. CNR and CNR, that's a CNR variance, which is this guy. Now, right here, CNR and DSG, negative 0.00144, that is covariance. So if I run this in Excel, you can also do this by hand. You can definitely do this by hand, which is similar to how you would do it on the table I showed you earlier, or you can touch it in the financial calculator. You get the covariance, get the variance, now I can actually calculate the portfolio But the thing that's still missing here, what is missing? What else do I need? The weights. Very good. The weights. So stay with me. The weights. Now let's take a look at this. What I have done here is I got column A and column B. Column A is the weight of DSG. Column B is the weight of CNR. Starting from all the top here, I have all the different scenarios. The very first one, line number 9, assuming that I have 0 weight in DSG and I have 100% CNR. And I slowly increase the weight of DSG to create all these 100 possible scenarios. Do you understand that case? This is all the possible scenarios of different combination of the two stocks. Now I have the weights, I have the variance, I have the covariance. I have what I need to calculate the expected return if I have the expected return of these two stocks. What I can do now, I have 100 scenarios of 100 possible combination of these two stocks. I can calculate 100 possible results of the expected return and the risk for the portfolio. What is the goal? Remind me again. Why are we doing this again? Why are we doing this? What are we trying to do in the portfolio? You guys, make sure you understand why you're learning this. Yes? No, not to predict. Not in this case. Yes?
Maximize return.
Yes, maximize return and minimize risk. That's what it is. I pick two stocks, I put them together. I want to find what is the perfect mix of this portfolio that will give me the highest return and the lowest risk. That is the reason why we're learning this. I have all these scenarios. Now I can literally pick which combination here gives me the highest return and the lowest risk. That's the idea. All right? Because I have two stocks, I have all these potential outcomes, I can graph them. Okay, stay with me again. If you have questions, please ask. Look at this graph. The y-axis is expected return, x-axis is the risk. So I graphed all the potential outcome from the table here into this. So you see this curve, meaning every single dot is actually not a line, it's just many dots that created that curve. So now, my question for you now is, in this curve, should you, meaning that again, these are all the potential combination of the two stocks. Look at my cursor. Should I invest in this spot? Should I? No. I should not invest here. Why? It's shitty. It has high risk, low return. So that's why we can actually cut this curve in half. And which half do we care? We always care about the top left section of it. Because again, the big picture, high risk, high return, low risk. We want to maximize return, minimize risk. So anything in the top left portion of it is what is preferred. So what you would see in most of the textbook is they will only show you part of it, which is something like this, right? In fact, if you plot everything, it's going to come down, it's going to be like a nice C shape. But what we see on the top left portion of this curve is called the efficient frontier. This is called the efficient frontier. Meaning that as a reasonable investor, you should only consider all the combination that lies on this line, on this part of the line, because it has the highest return, the lowest risk. No one wants to have low return and high risk. That's just silly. Nobody does that. So what you see on Excel is that there are two stocks, and hence you only see that line. In reality, we have more than two securities. We have 3, 4, or even 500. If we plot all the possible scenario, it looks like an area, not a line. It will look something like this in green. Same concept applies. You can invest anywhere in this shade green. Should you invest in number 1? So number 1 represents a certain breakdown of this portfolio. in one of the scenarios, should you invest in one? Anyone? No, you should not. Because number one, you can actually push it up with the same risk. I can actually get a higher return. So remember, what is the shaded green again? The shaded green is all the possible combination, all the possible scenario of different weights. In my simple example, it's just 1%, 99%, 2%, 98% because there are only 2 stocks. Imagine if there are 500 stocks, the combination is millions. It's gonna blow your mind. But the computer can do that. The computer can actually create all the million scenarios plotted in this whole area. So all you have to do is go into this, pick the most efficient combination. It's a very specific combination that you would find from this. We good? You sure? Okay. Again, I feel unfair because most of these will be revisited and even expanded in the C35 investment course. But I don't know why this is included in a B10, but I will give you the introduction of it. Yes?
If your return's super low, like near zero, can you have a really high risk? Because what are you like,
Say, rephrase your question.
If you have a stock and it's almost near zero in returns, what are you essentially like risking? Like a big
Well, it is possible that the expected return for a stock is 0.
Right.
But the question is, would you invest in it? Why would you invest in a stock that has expected return of 0?
I don't think I would.
So it's not a question, right? What's the minimum accepted return? You know, what's the minimum return that we should accept? Yes.
The risk-free.
The risk-free. We talked about that, right? If someone say, I guarantee, if the US government or the Canadian government said, I guarantee I'm gonna give you 2.67%, why would you go ahead and invest something that expected return is 0 with risk? So that's the fundamental thinking, right? Risk-free. Okay. So anyhow, that curve, that thick green line on the top, those are the most optimal portfolios. Okay. Now, to extend that, again, we're gonna bring this a little bit further. I will try not to test you on this because this is extending a little bit more deeper, but then it's important to understand why we're doing this, how we're doing this, right? We all agree that the efficient frontier is the most efficient, which is on the top left side of the curve. But where on that curve should we invest in? Right? There's still countless possibility or scenario on that line. So researchers were proposing, okay, you know what? Instead of thinking about 100% invested in this risky portfolio, which could be anywhere on that line, why don't we add one more asset to it? Meaning, we'll add risk-free. We'll add risk-free as one of the possible investment as well. Now that's interesting because risk-free is literally risk-free, so it would have 0 risk, but it has some kind of positive return. So that's why you see that dot with the RF, risk-free, right there. So researcher would suggest, okay, well, to find the most efficient portfolio to invest, let's just draw a line between risk-free and then just cut across that curve to see which portfolio in combination of risk-free and the risky portfolio will give us, again, what is the highest return and the lowest risk. Again, that's really the goal. High return, low risk. So you can draw a line, but then the question is, how should that line be drawn? So if you recall, the most furthest top left corner is the most efficient because high return, low risk. So they would plot a line crossing across risk-free, and it would just tangent to that efficient frontier, and that line would have the steepest slope of all the possible combinations. So that line is called the capital allocation line. That's the idea. And that line where it touches the efficient frontier will be called the portfolio M. Also, the optimal risky portfolio. So that is the best place that you should be investing in. Okay? Based on all the historical data, based on all the assumption, if you want to create a portfolio that would give you the most bang on the buck, that would be it. I just told you guys how to make money. Not how to pass the exam, but how to really create an optimal portfolio. This theory has been developed for over 70, 80 years, way before I was born. Nothing really has changed. So I'm curious if any of you guys in your generation can come up with another theory that can be better than this, you will be the next Nobel Prize winner. All right? The person who came up with that was a Nobel Prize winner. We'll talk about that in C10. Okay? So that is the optimal portfolio where the M is, where it touches. Remember, where it touches, it just represents that particular breakdown, that particular weight of a whole selection of stocks. So that exactly tells you how many shares you should buy for each stock, and that is the best portfolio. Okay, I'm gonna skip through this for the interest of time. Similar to what I have been telling you on Tuesday, yes, you can invest 100% on the portfolio, but if you start sliding down that capital allocation line, what does that mean? If I have a selection that is between risk-free, okay, let me rephrase. If you invest 100% here, this is your risk and reward profile, correct? If you invest 100% in M, that is your risk and reward profile. What happens if you invest anywhere between M and risk-free? You can actually control that. If I go 50% portfolio, 50% risk-free, you'll be there. Okay? And if I want to take more risk, what can you do? You can push it up here, meaning that I'm going to be borrowing money to invest in the market. So that's the idea, all right? So the idea is you should be investing anywhere on this black line, depending on your allocation between risk-free and the risky portfolio. Okay, I'm gonna take a 2-minute break before I continue. I wanna make sure that you guys can fully digest that. There are no dumb questions, trust me, I can tell by your face. It's not my first date, I know you guys are lost, and you guys can ask any questions, even I can repeat this from the beginning. I showed you what Bank of Canada website, right? You would go there. What is risk-free rate? It's there, right? It's not something that you would calculate. It's just what is the market risk-free rate. Good? Okay. The following material, the last 15 minutes, that you didn't go all the way to the end, it's going to be key. So, can I get your attention? Right. So we talked about risk. What is risk again? The best way to measure standard deviation, correct? But what if I tell you there's another way to measure risk? And that's called beta. Beta. Okay, beta particularly is the systematic risk. It's the risk that's correlated to the general market. That's why we call it market risk. How do we calculate beta? Beta is calculated by looking at the correlation between individual stock and the market return. I'll give you one example. This is from Tuesday's class. Remember CCO, chemical? This is a uranium miner. I have all these price. These are daily price for the last 5 years. I also have the TSX composite index, which I use as a proxy of the market. This is the market index. I have their daily performance on the same time. I can actually run a linear regression between this. So what's a linear regression again? I have a dependent variable and an independent variable. The independent variable is Y. The dependent variable is, sorry, the other way around. The independent variable is X. The dependent variable is Y. Correct? So we try to use X to predict Y. That's a linear regression. So in this case, I'm gonna use the market as X and the individual stock return as Y. Run a regression, and this is what it looks like. All right, you have access to this file. You guys can actually access this on your own. Again, don't worry, this material, I'm pretty sure, although I don't teach the C35, I'm sure this will cover again in the C-level courses. But I want to give you the idea of how this is created at the basic level. I have X and Y's. Again, X, market return, Y, chemical return, X and Y. This is a scatter plot, which I would just plot the X and Y here. So you see a bunch of blue. I want to see if chemical is actually having a particular relation or relationship with the TSX compensate. When TSX is up 1%, is CCO going to go up 1% as well, or close to 1%, more than 1%, less than 1%? Or I would want to look at every day and how these two actually correlate to one another. I plot everything in here, run a linear regression. This is the OLS regression. So the best fit line, that's statistics, right? Now this orange line is the best fit line. I know it's kind of silly, but that's the best I can do, best fit line. What I can get out of this is I can get the intercept of the line and the slope of the line. The slope of the line is called beta. All right, so if you can see here, here's the residual plot. And then the beta, there, 1.6744. That is the sensitivity of chemical, how we would react to the market change. So, this is why I tell the 9 o'clock class, write this down. What is beta? Beta measures systematic risk, all right? Meaning that, what is the sensitivity of the stock comparing to the market? That's what beta is. I'll repeat. Beta is a measure of systematic risk. And beta is the sensitivity between the stock that you're trying to measure to the general market. So those two things are about beta. You need to know that. It is in the exam. Okay, so this is beta. Beta measures the responsiveness of the security to the movement in the market portfolio, as you have seen in the past. Example with CCO. The formula of beta can be calculated with this. The beta of any individual stock equals the covariance between the stock's return and the market's return divided by the variance of the market's return. That's the general formula for beta. The average beta across all securities when weighted by the proportion of each security's market value to that of the market portfolio, meaning that if I want to mimic the market, what is the market beta? So this is a question in previous exam that you have to understand first. Beta, right, is the result of the linear regression. It's the sensitivity to the market. So what would be the beta of the market? What would be the beta of the market? Yeah.
1.
Very good. Please remember that. The beta of the market equals 1. What's the beta for risk-free asset? What's the beta for risk-free asset? Yeah. 0. Very good. Why? Risk-free asset has no correlation to the market. It doesn't matter the market go up or down. Risk-free will always pay. It's guaranteed. So risk-free has a 0 beta. The market has a beta of 1. Any stock will be anywhere in between or even negative. It's possible to have a negative beta. Okay. So now I want to show you an example. This is a past exam question. And the instructor in the past liked to use the student's name in their question, so you can find a bunch of students' name there. Sabrina wants to create a portfolio that is as risky as the market. She has $1 million to invest. Given this information, fill in the following table. So there are 3 question marks there. We got to fill in the blanks. So let's take a look at this. I gotta speed up. Okay, we got 4 investment, A, B, C, D, and risk-free, correct? We have the investment, A, 170, B, 140, C, 130, D, 200. Okay, first question. If Sabrina has $1 million, what would be the amount that is invested in risk-free? Let's do a quick calculation. I'll count on you guys. 360. Is that right? 360? She got $1 million, right? So it's just $1 million minus 170 minus 140 minus 130 minus 200. Whatever left over has to be in risk-free. 360. Good. First question mark solved. The next, beta. All right, some of them are given to you, 1.6, 1.5, 1.1. This one we need to solve, okay? We're gonna call it X. X. Risk-free, what's the beta for risk-free again? 0, thank you. Because it has no correlation to the market. This risk-free rate. Make sure you understand that. So now, how do we calculate? This is the portfolio of all these things. What's the portfolio beta? The portfolio beta is the weighted average of all these things. Weighted average. So meaning that I can actually calculate the weighted beta. The weighted beta. So 170 out of 1 million, that's 17% times 1.6. Can anyone give me 17% of 1.6?
0.272.
Okay. 14% of 1.5? 0.21. Okay. 13% of 1.1?
0.143.
And then that is 0.2x, right? We're trying to solve x. That is just 0. So what is the portfolio beta? The portfolio beta is the sum of that. Right? That's a portfolio beta. And we know that Sabrina wanted the portfolio beta to be equal to the market beta. What is the market beta again? 1. Thank you. So 1 equals 0.27 plus 0.21 plus 0.14 plus 0.2x. I'm sorry, these guys, we might have to come around, but that's it, right? 1 equals 0.27 plus. You're just adding all these together. So can you solve for x? That's it, done. What's x?
1.9.
1.9? That's it, that's the exam question in the past. Okay? You get the idea of beta? Just the weighted average and the sum of the weighted beta for the portfolio. 2 assumptions, or 2 things you need to know. Beta, again, what is beta? I'll repeat that again. Beta is the measurement of risk, the measurement of systematic risk. Beta is the sensitivity between the stock's return and the market's return. Can be calculated by that formula, or you can actually run a regression, which is the slope, which I showed you here. I don't know where it is. Go into there. All right, it's the slope between the return of the security and the return of the market. That is beta. All right. Now, the last and final important concept. Okay, again, at this point, it's just an introduction, all right? But this is one of the most important equation in finance called the CAPM. capital asset pricing model. Now, all we're trying to do so far is try to predict what the expected return is. We can do it if we have access to historical data. We would use what? Remember, arithmetic average, geometric average. Oh, by the way, to be fair, because I reminded the 9 a.m., that's on the exam. So, geometric average, arithmetic average. So which number gives the smaller one again? Geometric is smaller because there's a compounding effect there, right? And when we try to use these averages to predict expected return, we can either use arithmetic or use geometric. But then what if we're not happy with these two? There's an approach. There's an in-the-middle approach, right? So that's my hint. I have it on the last slide. Make sure you review that. So it's called the Bloom's formula, somewhere in between. All right. But then my point is, why do we do all that? We do all that is we try to use historical return to predict what's going to happen in the future. That's one way of doing it. The CAPM does it differently, but also the point is to predict what's going to happen in the future. They would use beta to do that. So instead of looking at all the historical return, they use beta and they use the expected market return. So what's the deal with this? Why is this so good? Because if I want to analyze 500 stocks, I don't need to measure the average of all 500 stocks. All I need here is that all I need is the beta for the 500 stocks. And I just have to estimate what is the expected market return and observe the risk-free. Then I can have the expected return for all 500 stocks or even more. All right? So that's why this is an alternative way to measure or expect return, to estimate the expected return for individual stock. So the equation goes like this. The expected return for any stock equals risk-free plus beta times market risk premium. And market risk premium is just the expected market return. So if it's Toronto stock, Canadian stock, we use the TSX. If it's US, most of the time we use the S&P 500 as a proxy of the market. And worst case in this, I can promise you this is going to be on the exam, but the only thing you need to know is to write down the equation if you can remember it. Because I understand it's the first time you see it, but after a few years of taking finance courses, this is going to be like ingrained in your brain. Like you know this equation when you see it. It's called CAPM. CAPM, expected return on the security, risk-free plus beta times market risk premium. All right? So make sure that you got this. Very important slide. Now let's take a look at some of the example how this is being used. So the analyst here observe, this is also a pass exam by the way. Okay, the instructor likes to use student names here, so these are the students who used to take the course. The student here, one, observe the following situation. You got A and B, two stocks, okay? The two stocks given is the beta and the expected return. Assume these securities are correctly priced. Based on CAPM, what is the expected return on the market? Now, that's interesting. What is the expected return on the market and what is risk-free rate? So this question tests a few things. Your familiarity with the CAPM equation, and mostly calculus. We're going to solve this. So we got two stocks. We got A. Okay, so remember, right? CAPM is the expected return of the stock equals risk-free plus beta of the stock times the return of the market minus risk-free. That was the formula. So now, let's look at stock A. We know the expected return. It was given to you, 15% equal risk-free plus, what's beta, 1.2? Okay, the problem is we don't know what is risk-free. We don't know what is the return of the market, because that's the question. We're just going to write it out. Investment B is going to give us 20% equal risk-free plus 1.8 and the return of the market minus risk-free. We got two equations, we got two unknown. Can we solve this? Can we solve? Yeah, we can solve this. We got two equations, two unknown. That's it to solve it. Then you're gonna have RF and you're gonna have RN. Okay. Do you want me to do it? Yeah? Okay, I'll do it. That's enough time. Okay, so let's take this apart. How do we do this? Let's wait. This is high school calculus. Tell me if I'm doing this wrong. Yeah, I think so. Right? Moving things apart. And then continue to move it. I don't know, pick one, right? Solve something. So maybe I'll go, how about that? Am I right? Just kind of moving things around. For B, B was 20%. $1.8. Okay, two equations, right? So then you're gonna have do I really have to do the rest of it? Again, this is just high school math. And then you got RF, you just substitute in one of those, and then you got RF. Okay? So, all in all, I'm not gonna do the rest. It's just, you guys can handle this. If you see any questions from the last two classes, you should be laughing. Most of the stuff were pretty easy. It's just plug and play. The hard one is gonna be the capital budgeting ones and the time value money questions. These are mostly based on theory that you understand. What is CAPM? How do you find average expected return and all that stuff? Just plug it into the formula, but mostly calculus. But then it's the capital budgeting that you gotta understand the question, moving things around. That's a hard one. But all in all, that's all I have for today. I do have another example. This is a harder one that is from previous exam. Instead of equal chance for each of the scenario, there are assigned probability for these things, and then you would calculate the same thing, expected return and the risk. Okay, so practice this as you wish. But before I wrap up, any questions or concerns? You good? Okay, well, again, thank you guys. This is the last class. Thank you for being patient with me. If you still have yet to fill out the evaluation, please do so. Exam is next week, so please work hard. The mock exam is there. Someone was asking me about the solution in part B. I'm still working on that. I'll try to give it to you guys maybe before tomorrow or something like that. Okay, good? All right, enjoy guys. I'll see you guys next week. Good luck. Office hours and everything.